Hi guys, welcome back to another video. In this video, we will be teaching about Head and Shoulders Forex pattern. 1. Introduction to the Head and Shoulders pattern. What is a Head and Shoulders pattern? Why is it important in Forex trading? 2. Anatomy of the pattern. Left shoulder head, right shoulder neckline. 3 dots. Bullish versus bearish. Head and shoulders, inverted head and shoulders, bullish. Standard head and shoulders, bearish. 4. Entry and exit strategies. How to place your entry points, stop loss placement, take profit targets. 5. Final thoughts and next steps. Welcome to today's video. We're diving into one of the most well-known and reliable chart patterns in Forex trading, the Head and Shoulders pattern. Whether you're new to trading or have some experience, understanding this pattern can help you spot potential market reversals and make more informed trading decisions. By the end of this video, you'll know how to identify the Head and Shoulders pattern, use it to plan your trades, and avoid common mistakes. Let's get started. What is a Head and Shoulders pattern? The Head and Shoulders pattern is a classic reversal pattern that signals a potential change in the direction of a trend. It consists of 3 peaks, the left shoulder, the head, and the right shoulder, with a baseline known as the neckline. This pattern typically forms after an uptrend, indicating a possible bearish reversal. However, there's also a bullish version called the inverted head and shoulders, which forms after a downtrend. Why is it important in Forex trading? In Forex trading, identifying potential trend reversals is crucial for maximizing profits and minimizing losses. The Head and Shoulders pattern provides traders with a visual cue that a current trend might be losing momentum. When identified correctly, this pattern can give you a clear entry and exit strategy, improving your overall trading performance. Anatomy of the pattern. Let's break down the structure of the Head and Shoulders pattern so you can easily recognize it on a chart. The pattern has 4 key components: the left shoulder, the head, the right shoulder, and the neckline. Left shoulder. The left shoulder forms when the price rises, then retraces to a certain level before rising again to form the head. This initial peak represents the first sign of potential weakness in the trend. Head. The head is the highest point of the pattern. It forms when the price rises above the left shoulder, then retraces again. This peak shows that buyers tried to push the price higher but couldn't sustain the momentum. Right shoulder. The right shoulder forms after the head. It's typically lower than the head, but similar in height to the left shoulder. The formation of the right shoulder indicates that the bullish momentum is fading and sellers are gaining control. Neckline. The neckline connects the lows of the left shoulder and the right shoulder. This line is crucial because a break below it confirms the Head and Shoulders pattern and signals a potential trend reversal. Bullish versus bearish Head and Shoulders. Now that we know the basic anatomy, let's differentiate between the 2 types of Head and Shoulders patterns: the standard, bearish pattern, and the inverted, bullish pattern. Inverted head and shoulders, bullish. The inverted head and shoulders is a bullish reversal pattern that forms after a downtrend. Instead of peaks, you'll see 3 troughs: a lower low, the head, flanked by 2 higher lows, the shoulders. When the price breaks above the neckline, it signals a potential upward trend. Standard head and shoulders, bearish. The standard head and shoulders pattern is a bearish reversal pattern that forms after an uptrend. It signals that the market might be shifting from a bullish trend to a bearish one. Once the price breaks below the neckline, it confirms the reversal. How to identify the pattern on charts. Identifying the Head and Shoulders pattern on charts takes practice. Let's go over some key characteristics to look for and common mistakes to avoid. Key characteristics. Three peaks: left shoulder, head, and right shoulder. A clear neckline connecting the lows. The right shoulder is typically lower than the head. Volume often decreases as the pattern forms. Common mistakes when identifying. Misidentifying random price movements as a head and shoulders pattern. Ignoring the importance of the neckline. Not waiting for a neckline breakout before entering a trade. Entry and exit strategies. Once you've identified a head and shoulders pattern, it's time to plan your trade. Let's talk about where to place your entry points, stop-loss orders, and take-profit targets. How to place your entry points. Enter a trade when the price breaks below the neckline in a bearish head and shoulders pattern, or above the neckline in a bullish inverted head and shoulders pattern. It's essential to wait for a confirmed breakout to reduce the risk of false signals. Stop-loss placement. Place your stop-loss order just above the right shoulder in a bearish pattern, or just below the right shoulder in a bullish pattern. This helps protect your capital in case the breakout fails. Take-profit targets. To calculate your take-profit target, measure the distance between the head and the neckline. Then, project that distance from the neckline breakout point. This gives you a realistic target for potential profit. Risk management tips for trading. This pattern. Risk management is crucial when trading any pattern. Here are some tips to manage your risk effectively when trading the head and shoulders pattern. Position sizing. Never risk more than 1 to 2% of your trading capital on a single trade. Use proper position sizing to ensure that you can withstand potential losses. Avoiding false breakouts. Wait for a clear and decisive breakout before entering a trade. False breakouts can lead to losses, so it's better to be patient and wait for confirmation. Real chart examples. Let's take a look at some real chart examples to see how the head and shoulders pattern forms in live markets. We'll also analyze historical data to understand how the pattern played out in the past. Spotting the head and shoulders in live charts. Look for patterns in different time frames, such as 1 hour, 4 hour, and daily charts. The pattern can appear in any time frame, but higher time frames tend to produce more reliable signals. Analyzing historical data review. Past instances of the head and shoulders pattern to see how it performed. This helps you build confidence in identifying and trading the pattern. Common mistakes to avoid. Even experienced traders can make mistakes when trading the head and shoulders pattern. Here are some common pitfalls and how to avoid them. Misinterpreting the pattern. Ensure that the pattern is well defined before trading. Avoid forcing the pattern onto the chart if it doesn't clearly meet the criteria. Ignoring volume confirmation. Volume is a crucial component of the head and shoulders pattern. A significant increase in volume during the breakout confirms the validity of the pattern. Combining head and shoulders with other indicators. To increase the accuracy of your trades, combine the head and shoulders pattern with other technical indicators like RSI, MACD, and moving averages. Using RSI, the Relative Strength Index, RSI, can help confirm overbought or oversold conditions, increasing the reliability of the pattern. Using MACD, the Moving Average Convergence Divergence, MACD, can help identify changes in momentum, further confirming the pattern. Using moving averages can help identify the overall trend and provide additional confirmation for the head and shoulders pattern. Q&A section /FAQs. Let's address some common questions about the head and shoulders pattern. Can the pattern fail? Yes. Like any trading strategy, the head and shoulders pattern can fail. That's why risk management is essential. Always use stop-loss orders to protect your capital. What time frames are best for this pattern? The pattern can appear on any time frame, but it's most reliable on higher time frames like the 4-hour, daily, or weekly charts. Final thoughts and next steps. To wrap up, we've covered everything you need to know about the head and shoulders pattern, from identifying it to implementing it in your trading strategy. Remember, practice makes perfect. Take the time to study charts and practice identifying the pattern before risking real money. If you found this video helpful, don't forget to like, comment, and subscribe for more trading content. See you in the next video, and happy trading.